Legal disclaimer. Please listen carefully to the following statement before we proceed. The content presented in this video and throughout this entire masterclass series is strictly for educational and entertainment purposes only. Nothing you hear, see, or read in this material constitutes professional financial, investment, tax, or legal advice. Foreign exchange trading, commonly known as Forex, involves the exchange of currencies on margin and carries a significantly high level of risk that may not be suitable for all investors. The high degree of leverage available in these markets can work against you as well as for you. There is a genuine possibility that you could sustain a loss of some or all of your initial investment, and in certain cases, incur losses exceeding your deposit. Therefore, you should not invest money that you cannot afford to lose. We are analyzing historical data, chart patterns, and economic theories to understand market movements. Past performance of any trading system or methodology is not necessarily indicative of future results. Any case studies, examples, or testimonials presented are not typical and do not guarantee that you will achieve similar results. The financial markets are dynamic, volatile, and unpredictable. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. If you have any doubts, you are strongly advised to seek advice from an independent, certified financial advisor. By continuing to watch this video, you acknowledge that you are solely responsible for your own financial decisions and the outcomes that result from them. Now look at the device in your hand or the screen in front of you. It is a gateway, but it is not a gateway to easy money, and it is certainly not a gateway to a guaranteed retirement next week. You have likely seen the advertisements. You have seen the influencers renting supercars, flashing stacks of cash, and promising that if you just download this one app and follow their signals, you will crack the code to wealth. I need you to take everything you have seen on social media regarding trading, ball it up, and throw it in the mental trash can. Here is the reality that those 30-second clips will never tell you. You are stepping into an arena where the average daily turnover is approximately $7.5 trillion. To put that number into perspective, the New York Stock Exchange, the largest equities market in the world, trades roughly $200 to $250 billion per day. The Forex market is not just bigger. It is a leviathan. It is 30 to 40 times larger than the entire US stock market combined. This is not a playground. It is a battlefield dominated by central banks, sovereign wealth funds, colossal hedge funds, and high-frequency trading algorithms that operate in nanoseconds. These entities have billions of dollars in capital, armies of mathematicians, and proprietary technology that costs more than most neighborhoods. And you? You are the retail trader. You are the small fish swimming in an ocean full of sharks, whales, and krakens. That sounds intimidating. Good. It should be. Fear is the first step toward respect, and respect is the currency of survival in the financial markets. But here is the controversial truth that keeps the smart money quiet and the new traders broke. The market is rigged, but not in the way you think. It is not rigged against you personally. The market does not know you exist. It is rigged in favor of liquidity. It is rigged in favor of volume. It operates on specific mechanical rules of supply and demand that have governed commerce since the Babylonians, just accelerated by fiber optic cables. The reason 90% of retail traders lose 90% of their money in their first 90 days is not because the market is impossible to beat. It is because they are trying to play a professional sport without ever learning the rules, wearing the wrong equipment, and ignoring the physics of the game. They treat a $7.5 trillion global economy like a slot machine in Las Vegas. This video and the 9 parts that follow is the antidote to that gambling mentality. We are not here to sell you a signal service. We are not here to hype up a broker. We are here to conduct a deep dive masterclass, essentially a university-level semester compressed into a comprehensive video series that will strip away the noise and expose the mechanical gears of the global currency markets. We are going to solve the single biggest problem facing aspiring US-based traders today: the knowledge gap. In the United States specifically, you face a unique set of regulatory hurdles that the rest of the world does not. You have the FIFO rule, first in, first out. You have strict leverage caps set by the CFTC and NFA, usually limited to 50:1 on major pairs, whereas traders in other jurisdictions might recklessly access 500:1. You have the inability to hedge positions in the same account. Most generic advice on the internet ignores these crucial constraints, setting American traders up for immediate compliance failure before they even place a trade. This series addresses those specific nuances. We are going to teach you how to navigate the US regulatory environment, how to utilize it to your advantage for risk management, and how to operate with the professionalism of a prop firm trader rather than a gambler. Our promise to you is clarity. By the end of this series, you will not just know how to click buy or sell. A trained monkey can click a button. You will understand why price moves. You will understand the geopolitical flows that cause the Japanese yen to strengthen when the US stock market crashes. You will understand why interest rate differentials between the Federal Reserve and the European Central Bank create trends that can last for months. We are going to move beyond simple technical analysis, drawing lines on a chart, and integrate fundamental analysis and sentiment analysis to give you a three-dimensional view of the financial world. We are going to dismantle the process of starting Forex trading into 5 distinct, non-negotiable steps. This is not about skipping to the finish line. If you try to build the roof of a house before you pour the foundation, the structure will collapse the moment the wind blows. In trading, that wind is volatility, and it blows every single day. Step 1 is not opening an account. Step 1 is not depositing money. Step 1 involves a radical restructuring of your psychology and your expectations. Consider this. When a surgeon steps into an operating room, they have spent a decade studying anatomy, practicing procedures, and understanding the risks. When a pilot steps into a cockpit, they have logged thousands of hours in simulations before they are trusted with passengers. Yet, in trading, people deposit their life savings on a Tuesday after watching a 10-minute tutorial on a Monday. This behavior is financial suicide. We are here to stop that cycle. Throughout this masterclass, we will explore the concept of edge. In probability theory, an edge is simply a statistical advantage that plays out over a large sample size of events. The casino has an edge in roulette. That is why the house always wins in the long run, even if a player wins a lucky hand in the short run. Your goal as a trader is to become the house. You need to stop acting like the gambler throwing dice and start acting like the casino manager who understands that while individual outcomes are random, the aggregate outcome is mathematically predictable. We will look at the specific data regarding risk of ruin. We will examine the Kelly criterion and how it applies to position sizing. We will discuss the physiological response your body has to losing money, the cortisol spike, the fight or flight response, and how that biology hijacks your logical brain, causing you to make the worst possible decisions at the worst possible times. We will construct a trading plan that functions like a business contract with yourself, one that defines your entry criteria, your exit criteria, and your risk management protocols in stone before the market even opens. This journey requires patience. If you are looking for a quick dopamine hit, click away now. There are plenty of entertainment channels that will tell you what you want to hear. But if you are ready to treat this with the seriousness of a career, if you are ready to understand the flow of capital that dictates the cost of the gas in your car and the food on your table, then you are in the right place. We are about to dissect the largest market in human history. We are going to peel back the layers of complexity to reveal the simple, brutal truths of price action. The open loop I want to leave you with before we dive into the first step is this. There is a specific time of day, a distinct window of roughly 90 minutes, where nearly 60% of the daily volume for the specific currency pairs we will target is transacted. It is a phenomenon known as the London-New York overlap. Most amateur traders lose money because they are trading in the dead zones, the low-liquidity deserts where price chops around aimlessly. The professionals wait. They wait like snipers for this specific window of time where the institutional money flows like a tidal wave. Later in this series, I am going to show you exactly when that window opens and how to position your boat to catch that wave rather than drowning in it. Prepare your notes. Close your other tabs. Put your phone on silent. This is not a vlog. This is part 1 of the comprehensive guide on how to start Forex trading. Let us begin. One of the next steps would be to structure the specific 5 distinct steps mentioned in the promise, starting with step 1, the psychological foundation and expectation setting. Step 1 is the only step that usually causes people to close the video. It is not sexy. It involves 0 charts, 0 indicators, and 0 excitement. But if you skip this, you are statistically guaranteed to fail. Step 1 is the psychological foundation and expectation calibration. Let us run a simulation. Imagine you are sitting at your desk. You have deposited $1,000 of your hard-earned savings into a brokerage account. You spot a setup on the British pound against the US dollar. It looks perfect. The trend is up, the news is good, and your gut tells you this is the one. You enter the trade with a standard position size. Immediately, the candle turns green. You are up $50, then $100, Your heart rate accelerates. The dopamine floods your brain. You start doing the mental math. If I make $100 in 10 minutes, I can make $600 an hour, $4,000 a day. I can quit my job next month. Then the candle stops. It wicks down. It turns red. You are now up only $10. Then you are down 20. Panic sets in. This wasn't part of the plan. You stare at the screen, willing the price to move back up. You tell yourself, it has to turn around. The support level is right there. You move your stop-loss order further away to give the trade room to breathe. The price drops further. You are now down $200. That is 20% of your account gone in an hour. You are sweating. You are not analyzing anymore, you are praying. Finally, the broker's automated system triggers a margin closeout. You have lost half your account. You feel physically ill. This scenario plays out thousands of times every single day across the United States. It happens because the trader entered the market with the mindset of a gambler, not a risk manager. The first pillar of your psychological foundation is dismantling the get-rich-quick fallacy. Social media algorithms feed you a highlight reel of the top 0.1% of outcomes. You see the withdrawals, but you never see the deposits. You see the winning trade, but you never see the 10 losing trades that preceded it. We need to look at the cold, hard data of professional performance. The best hedge fund managers in the world, titans like Ray Dalio or George Soros, historically target annual returns between 15% and 30%. If the smartest minds in finance, equipped with supercomputers and insider research, are thrilled with 20% a year, why do you believe you can make 20% a day? If you start with $1,000 and aim for 1% growth per trading day, compounding that capital without ever withdrawing, the mathematics suggest you would have millions of dollars within a few years. If that were easily achievable, inflation would destroy the global economy because everyone would be a billionaire. The market is efficient. It does not hand out free money. You must recalibrate your expectations to target consistency, not home runs. A realistic, professional target for a skilled retail trader might be avoiding losses for the first year, and then aiming for small, incremental monthly gains that outperform the S&P 500. The second pillar is understanding the biological disadvantage you possess. As a human being, you are evolutionarily designed to be a terrible trader. We are wired for survival, which means we are wired for loss aversion. Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky developed prospect theory, which proves that the emotional pain of losing $1,000 is roughly twice as intense as the emotional pleasure of gaining $1,000. This asymmetry creates a disastrous feedback loop in trading. When a trade goes into profit, your fear of losing that profit makes you close the trade too early, missing out on the big move. Conversely, when a trade goes into a loss, your avoidance of pain makes you hold on to it, hoping it will come back, turning a small, manageable scratch into a catastrophic account-blowing event. You have to rewire your brain to accept losing as a business expense. Think of a retail store owner. When they buy inventory, say 100 t-shirts, that costs money. They don't cry about the money lost to buy the shirts. It is the cost of doing business. In Forex, losing trades are your inventory. They are the raw material you consume to find the winning trades. If you cannot accept a loss without an emotional reaction, you cannot trade. Period. Let's look at a comparative case study to solidify this. We have Trader A, let's call him the hunter, and Trader B, the casino manager. The hunter wakes up and needs to kill something to eat. He needs to make money today to pay his rent. He forces a trade on the euro to US dollar pair because he feels the dollar is weak. He risks 10% of his account on this single idea because he needs a big payout. The trade fails. He is now desperate. He opens a second trade twice as large to win back the money. This is revenge trading. He is trading his emotions, not the market. The casino manager walks onto the floor. He knows that on any given spin of the roulette wheel, the outcome is random. He does not care if the ball lands on red or black this specific time. He cares that over 1,000 spins, the statistical edge of the green 0 and 0-0 ensures the house makes money. He risks only 1% of his capital on any single trade. If he loses, he has 99% of his ammunition left. He is indifferent to the outcome of a single event because he is playing the law of large numbers. You must become the casino manager. You must detach your self-worth from the result of the trade. This brings us to the final component of step 1, defining your risk capital. This is a term mandated by regulators, but it is often ignored. Risk capital is money that, if lost entirely, will not change your standard of living. It will not mean missing a mortgage payment. It will not mean skipping a meal. If you are trading with money you need, you are trading with scared money. Scared money always loses. Why? Because you cannot make rational decisions when your survival is on the line. If the rent is due in 3 days and you are down $50, you will panic. You will close the trade at the bottom, right before it reverses and goes in your direction. You must segregate your trading funds entirely from your life funds. If you only have $200 that you can truly afford to set on fire, then you start with $200. You do not borrow. You do not use credit. You start small to build the mental callus required to handle the pressure. Before we even look at a currency pair, you need to sign a mental contract with yourself. This contract states, I accept the risk. I am not here to get rich quick. I am here to learn a skill that takes years to master. I will operate based on probabilities, not certainties. If you can sign that contract, you have passed the first hurdle where 90% of people trip and fall. You have the software, the mindset installed. Now we need to build the hardware. We need to construct the actual infrastructure that allows you to access the global interbank market. You might think this just means downloading an app on your phone. You would be wrong. The bridge between you and the $7.5 trillion market is fraught with technical landmines, hidden fees, and conflicting regulatory structures that vary wildly depending on which state you live in. Choosing the wrong broker or the wrong charting platform can cost you thousands of dollars in spread and slippage before you even realize what is happening. In the next part of this masterclass, we are going to open the hood of the Forex engine. We are going to navigate the complex world of brokers, regulation, and the essential tools you need to see the market clearly. We are going to show you how to set up a professional-grade trading station for the cost of a Netflix subscription. Don't move. The setup begins now. Step 2 involves navigating the minefield of infrastructure. We are talking about the broker, the platform, and the data. If Step 1 was about building the mental software, Step 2 is about securing the connection to the global financial grid. Most beginners think a broker is their friend. They believe the broker is a benevolent partner helping them access the market. Let's shatter that illusion immediately. In the retail Forex world, your broker is a business, and depending on the type of broker you choose, they might be a business that profits directly from your failure. To understand this, you need to understand the difference between a dealing desk and an ECN, or electronic communication network. Imagine a casino. When you play blackjack, you are playing against the house. If you win, the casino loses money. If you lose, the casino keeps your chips. This is the dealing desk model, often referred to in the industry as the B-book. When you place a buy order for the euro against the dollar, a dealing desk broker takes the other side of that trade. They do not send your order to the real market. They hold it internally. They are betting against you. Since they know that statistically 90% of retail traders lose money, it is a very safe bet for them. They want you to trade frequently, over-leverage, and lose. Contrast this with an ECN or A-book broker. These brokers act as a conduit. When you buy, they instantly match your order with a seller in the real market, perhaps a bank in Zurich or a hedge fund in Singapore. They do not care if you win or lose. They make their money on the commission or the spread, which is a small fee charged on every transaction. Their incentive is for you to survive and keep trading so they can keep collecting commissions. For a US-based trader, your options are strictly defined by federal law. Following the 2008 financial crisis, the United States implemented the Dodd-Frank Act, which imposed some of the strictest financial regulations on the planet. This is where many new traders get into trouble. They go on YouTube, watch a creator from the UK or Australia who suggests a specific broker offering 500:1 leverage, and they try to sign up. If you live in the US, you cannot legally use those brokers. If you manage to bypass their geo-blocking using a VPN, you are putting your capital in extreme danger. If an unregulated offshore broker decides to freeze your account and disappear with your money, you have zero recourse. The FBI cannot help you. The SEC cannot help you. Your money is simply gone. Therefore, the non-negotiable rule for US traders is to ensure your broker is registered with the CFTC, Commodity Futures Trading Commission, and is a member of the NFA, National Futures Association. You can literally go to the NFA website, type in the broker's name, and see their regulatory history. If they are not there, or if they have a history of fines for slippage and unethical practices, you run away. Let's talk about leverage in the US context. US regulations cap leverage on major currency pairs at 50:1. This means for every $1 you have in your account, You can control $50 worth of currency. Many beginners complain about this. They want the 500:1 leverage they see advertised offshore. Here is the truth. The 50:1 cap is actually a safety belt. High leverage is the primary reason new accounts blow up. With 500:1 leverage, a tiny 0.2% move against you can wipe out your entire account balance in seconds. With 50:1, you have more breathing room. The US regulators are effectively forcing you to drive the speed limit. It might feel slower, but you are far less likely to crash the car on the first turn. Now let's move to the spread. This is the cost of doing business. Imagine you are at an airport. You want to exchange dollars for euros. The board says, we sell euros at 1.10, and we buy euros at 1.05. That difference, that gap between the buy price and the sell price, is the spread. In Forex trading, we measure this in pips, or points in percentage. If you are scalping, trying to make small profits on quick moves, the spread is your enemy. If the spread is 2 pips, and you want to make a 5-pip profit, the market actually has to move 7 pips in your direction just for you to hit your target. You start every trade in the negative. This is why choosing a broker with tight spreads and transparent commissions is vital. You need to treat this like a business supply chain. You are looking for the lowest cost of raw materials to maximize your profit margin. Next, we must address the platform. This is your cockpit. This is where you interpret the data. There is a massive distinction between your execution platform and your analysis platform. Most US brokers will offer you MetaTrader 4, MT4, or MetaTrader 5, MT5. When you open these programs, they look like they were built for Windows 95. They are clunky, gray, and ugly, but they are robust. They are the engines that connect to the bank servers. However, for analyzing charts, drawing trend lines, and spotting patterns, MT4 is terrible. This is why nearly every professional trader uses a third-party analysis tool, with the industry standard being TradingView. Your workflow will likely look like this. You have TradingView open on your main screen. This is where you do your homework. You use their advanced charting tools to find the setup. You calculate your entry price and your stop loss. Then, and only then, do you turn to your broker's app or MT4 to actually punch in the numbers and execute the trade. Do not confuse the two. Use the best tool for the job. Finally, let's dispel the hardware myth. You have seen the photos on Instagram. A desk with 6 monitors, a wall of screens flashing green and red numbers, a dedicated server rack. You do not need that. In fact, for a beginner, that is a distraction. More screens usually equate to more confusion. You end up watching too many things at once, leading to analysis paralysis. Case studies of successful retail traders often show them starting with a single decent laptop and a stable high-speed internet connection. The internet connection is the only hardware variable that matters. If your internet cuts out for 30 seconds while you are in a trade during a news event, you are flying blind. You cannot close the position. By the time you reconnect, your account could be decimated. So, your setup checklist is simple but strict. A CFTC/NFA regulated US broker. Safety first. An A-book or ECN account type if available. Aligning incentives. TradingView for analysis. Clarity. MT4 or the broker's proprietary app for execution. Reliability. Hardwired internet or a reliable 5G backup. Security. We have now secured the perimeter. You have the mindset of a casino manager. You have the infrastructure of a professional. Your capital is safe from fraud and your tools are sharp. But having the best car in the world is useless if you do not know how to drive. You can stare at a chart of the euro to US dollar all day, but if you cannot read the language of price, it will just look like random jagged lines moving to the right. The market is speaking to you every second. It leaves clues. It tells you where the money is hiding, where the fear is building, and where the next explosion is likely to happen. To read these clues, we need to learn a new language. In step 3, we are going to decode the candlestick. It is a Japanese invention from the 18th century used to trade rice, and today, it is the primary tool used to trade trillions of dollars. I am going to show you how a single bar on a chart can tell you a story of a war between buyers and sellers, and how to spot exactly who won that war so you can join the winning side. We are moving from theory to practice. Step 3 is where we start reading the map. Do not blink. Step 3 is mastering technical analysis. If step 1 was the mind and step 2 was the machine, step 3 is the map. Most people look at a price chart and see chaos. They see green and red bars flashing randomly. But to a trained professional, a chart is not random. It is a visual representation of mass human psychology. It is a graphical record of fear and greed playing out in real time, with billions of dollars on the line. We are going to start with the atomic unit of the Forex market, the Japanese candlestick. Shutterstock. Originating from rice merchants in 18th century Japan, this tool is vastly superior to a simple line chart because it tells you 4 distinct pieces of information in a specific period: the open, the high, the low, and the close, OHLC. Let's dissect a single bullish candle. Imagine we are analyzing a 1-hour time frame. The open is where the price stood at the top of the hour. The close is where the price finished at the end of the hour. The solid block between them is the body. This represents the conviction of the move. But the most critical part of the story is often the thin lines sticking out of the top and bottom. These are the wicks or shadows. Here is the secret that textbooks often miss. The wicks represent failure. If you see a long wick sticking out of the top of a candle, it means that at some point during that hour buyers were aggressive. They pushed the price all the way up to that high point. They were screaming, "The price is going higher." But they failed. Sellers stepped in with overwhelming force and smashed the price back down, leaving a visual scar of that failed attack. Understanding this allows you to read the sentiment of the market. Let's look at a specific, high-probability pattern known as the pin bar, or hammer. Imagine you are watching the euro to US dollar. The price has been dropping for 3 hours. The market feels heavy. Everyone is bearish. Suddenly, the next candle opens and drops sharply. It looks like the crash is continuing. Panic sellers jump in. But then something changes. Institutional orders, big banks looking for a discount, trigger at a specific level. The price reverses. It rallies all the way back up and closes near its opening price. What remains on the chart is a small body with a very long tail pointing down. This is a hammer. It screams rejection. It tells you that the market tried to go lower, found buyers, and was rejected. It is a clue that the momentum is shifting from bearish to bullish. This is not a guarantee that price will skyrocket, but historically, it suggests that the sellers have run out of ammunition. However, a single candle is not enough. You cannot trade based on one bar alone. That is like trying to read a sentence by looking at a single letter. You need context. This brings us to market structure. The market moves in waves. It breathes. It has an impulse and it has a correction. An uptrend is defined mechanically as a series of higher highs, HH, and higher lows, HL. A downtrend is a series of lower highs, LH, and lower lows, LL. This sounds simple, yet beginners constantly violate the laws of structure. They see the price skyrocketing and they buy at the very top, the higher high. This is FOMO, fear of missing out. Then the market naturally corrects down to form a higher low, and they panic and sell for a loss. The professional waits. The professional identifies the trend, waits for the pullback, the breath, and enters when the price is cheap, within the context of an uptrend. To do this effectively, you must identify support and resistance. But you need to delete the idea of precise lines from your mind. The market is not precise geometry. It is a fluid zone of liquidity. Think of support as a floor. It is a price zone where historically, buyers have stepped in because they perceive value. Think of resistance as a ceiling. It is a zone where sellers step in because they perceive the price is too expensive. Let's combine these concepts into an imagine if scenario to see how a professional trade is constructed. Imagine you are analyzing the chart of the British pound, pound sterling to US dollar. Structure analysis. You look at the chart and see the trend is clearly up. The market is making higher highs. You know you only want to be a buyer. You are not trying to short the market against the momentum. Zone identification. You identify a support zone. You see that 3 days ago, when price hit 1.2500, it bounced aggressively. You draw a rectangular box around that area. Patience, you wait. This is the hardest part. You watch the price drop towards your zone. It hits 1.2500. Do you buy blindly? No. You wait for a confirmation signal. The trigger. You watch the reaction. You see a hammer candle form exactly inside your support zone. This is called confluence. You have trend up, plus location support, plus trigger hammer. When you stack these probabilities, you are no longer gambling. You are executing a business plan. You are identifying a scenario where the historical likelihood of price moving up is significantly higher than it moving down. But here is where the novice gets slaughtered. They see the pattern but they zoom in too close. They are looking at the 1-minute chart or the 5-minute chart trying to catch micro movements. The noise on these lower time frames is deafening. A hammer on a 1-minute chart is often meaningless. It is just a blip of algorithmic data. A hammer on a 4-hour or daily chart involves millions, sometimes billions, of dollars changing hands to create that shape. It carries weight. It carries authority. For this masterclass and for your start in trading, we are going to focus on the higher time frames, the 1-hour, 4-hour, and daily charts. This filters out the noise and slows down the game, allowing you to make rational decisions rather than reactive ones. There is one more piece of the map we must discuss: the trend line. While horizontal support and resistance are static, trend lines are dynamic. By connecting the higher lows of an uptrend with a diagonal line, you create a visual guide of the trend speed. When price returns to this diagonal line, it often acts just like a horizontal support level. It is a dynamic floor rising with the price. So you now have the tools to read the chart. Candlesticks, the immediate sentiment, the sentence, market structure, the overall direction, the chapter, support/resistance, the key locations, the setting. You can identify what is happening. You can see the buyers are exhausted. You can see the trend is up. You can see we are at support. But this leads to the most agonizing question for every trader. When exactly do I pull the trigger? Do you buy the moment the candle closes? Do you wait for a retest? Do you place a limit order? And even more importantly, if you are wrong, because even the best setups fail, where exactly do you get out to protect your account? We have the map, but we don't have the battle plan. Step 4 is where we build the system. We are going to construct a rigid, rule-based algorithm for your decision-making process. We are going to define your entry criteria and your exit criteria so clearly that a robot could execute them. If step 3 was learning to read, step 4 is learning to write your own paycheck. But to do that, you need to understand the concept of risk to reward, a mathematical ratio that allows you to lose 60% of your trades and still make a fortune. I am going to show you the math that casinos hide from you. Get your calculator ready. Step 4 is next. Step 4 is the mathematical framework. If you ignore everything else in this series and only remember this section, you still have a fighting chance at survival. If you master technical analysis but ignore this, you will go bankrupt. It is a mathematical certainty. Step 4 is constructing the risk-to-reward ratio. This is the concept that separates the gambler from the professional fund manager. The amateur trader is obsessed with win rate. They want to know, how often is this strategy right? They think they need to be right 80% or 90% of the time to make money. This is a lie sold by marketers who have never traded a live account. In the professional world, a 90% win rate is often a red flag. Why? Because to achieve a 90% win rate, you usually have to take tiny profits and hold on to massive losses, hoping they turn around. You risk $10 to make $1. You are picking up pennies in front of a steamroller. Eventually, the steamroller catches you, and one bad trade wipes out months of perfect 90% win rate history. The professional does the opposite. The professional is obsessed with risk to reward. Let's break down the math. Imagine you have a strategy with a pathetic 40% win rate. That means out of 10 trades, you lose 6 of them. You are wrong more often than you are right. Most people would quit. But the professional structures their trades so that for every $1 they risk, they aim to make $3. This is a 1-to-3 risk-to-reward ratio. Let's run the numbers on a sample size of 10 trades. Risking $100 per trade. You lose 6 trades. That is 6 multiplied by $100. You are down $600. You win 4 trades. That is 4 multiplied by $300. Because your reward is 3 times your risk. You are up $1,200. Your net profit is $1,200 minus $600. You made $600 profit. You failed 60% of the time, yet you made a 60% return on the capital risked. This is the edge. This is how casinos operate. They don't win every hand of blackjack. They just ensure the payout structure is mathematically tilted in their favor over the long run. Now we need to integrate this math into your trade execution checklist. Before you ever press buy or sell, you must define 3 specific numbers. If you cannot define them, you do not have a trade, you have a gamble. Number 1, the entry price. This is obvious. It is where you get in. Number 2, the stop loss, SL. This is the most critical number in your career. The stop loss is your invalidation point. It is not a random number. You do not place your stop loss at 20 pips. Because that's what I always do. You place it at the technical level where your trade idea is proven wrong. If you are buying at support, your stop loss goes below the support zone. If the price breaks that floor, your reason for buying is gone. The trade is invalid. You must exit immediately. The stop loss is the automatic eject button that saves your life. Number 3. The take profit TP. This is your target. Again, this is not based on, I want to make $500 to buy a PlayStation. The market does not care about your PlayStation. The take profit must be based on market structure. If you are buying at support, your target is the next resistance level. That is where sellers are likely to step in. Here is the golden rule of step 4. You measure the distance from your entry to your stop loss, the risk. Then, you measure the distance from your entry to your take profit, the reward. If the reward is not at least 2 times the risk, a 1-to-2 ratio, you do not take the trade. You simply walk away. Case study. Imagine you see a beautiful setup on the US dollar to Japanese yen. The trend is up. There is a hammer candle. Everything looks great. You calculate your stop loss needs to be 50 pips away to be safe below the swing low. You look at the next resistance level, and it is only 50 pips away. This is a 1:1 trade. You are risking $1 to make $1. Despite the perfect technical setup, the math is bad. A professional trader scraps this trade instantly. They wait for a setup where the stop is tight, maybe 20 pips, and the target is far 100 pips, giving them a 1-to-5 ratio. But knowing your ratio is useless if you don't know position sizing. This is the technical mechanic that destroys 90% of US retail traders in their first month. Most beginners open their platform and see lot size. They see a default setting, maybe 1.0 or 0.1. They use that same size for every trade. This is madness. If you have a stop loss of 10 pips on one trade, and a stop loss of 100 pips on another trade, using the same lot size means you are risking 10 times more money on the second trade. You are wildly fluctuating your risk. You must use a position size calculator. The formula is account equity * risk percentage / stop loss in pips * pip value equals lot size. This sounds complex, but it ensures consistency. Let's say you have a $10,000 account. You decide to risk 1% per trade, $100. Trade A has a 20 pip stop loss. The calculator tells you to trade 0.5 lots. Trade B is more volatile and requires a 50 pip stop loss. The calculator tells you to trade 0.2 lots. In both scenarios, if you hit your stop loss, you lose exactly $100. This is consistency. This levels the playing field. Whether the market is calm or volatile, your dollar risk is locked in stone. This keeps your emotions in check, because you know exactly how much you will lose before you enter. There are no surprises. So, step 4 culminates in a rigid if-then algorithm. You write this down. You tape it to your monitor. If price is in an uptrend, higher highs, and price retraces to a key support level, and a bullish reversal candle closes, and the risk to reward is at least 1:2, then I execute the trade with 1% risk. If any single one of those conditions is not met, you sit on your hands. You do nothing. Trading is 10% execution and 90% waiting. It is the art of doing nothing until the money is lying in the corner waiting to be picked up. We have now covered the psychology, step 1, the infrastructure, step 2, the technical analysis, step 3, and the mathematical system, step 4. You might feel ready. You have the car, the map, the fuel, and the destination. But there is a monster lurking in the dark. It is an invisible force that can invalidate every trend line, shatter every support zone, and blow through your stop loss as if it wasn't even there. It operates on a schedule, yet it catches millions of traders off guard every single week. Technical analysis tells you where price has been, cannot tell you why price is about to move 100 pips in 3 seconds. Step 5 is the final piece of the puzzle. It is the study of the engine itself. We are going to learn how to read the economic calendar and how to protect yourself from the fundamental events that shake the world. We are about to enter the war room of central banks. Step 5 is next. Step 5 is fundamental analysis. If technical analysis is the study of the waves on the surface of the ocean, fundamental analysis is the study of the currents deep below that drive the entire body of water. You can be the best surfer in the world, reading every wave perfectly, but if the tide goes out, you are going to hit the rocks. Many retail traders, especially those relying solely on charts, ignore this step. They say, price discounts everything. They believe that all news is already reflected in the chart. To an extent, they are right, but they are missing the critical moments when the market is repricing value in real time. These are the moments that create the massive candles that blow accounts. You are not trading a company like Apple or Tesla. When you trade the euro to US dollar, you are trading the economy of the European Union against the economy of the United States. You are betting on the relative strength of one superpower against another. What drives that strength? One word: yield. Money is like water. It flows to where the return is highest and the risk is lowest. If the United States pays 5% interest on its bonds, and Europe pays only 2%, global investors, hedge funds, sovereign wealth funds, insurance companies will sell their euros and buy US dollars to purchase those US bonds. This selling of euros and buying of dollars causes the euro to US dollar chart to crash. This mechanism is controlled by central banks. In the US, it is the Federal Reserve, the Fed. In Europe, the ECB. In the UK, the Bank of England. These institutions are the whales. You are the plankton. When the Federal Reserve decides to raise interest rates to fight inflation, they are essentially turning on a giant vacuum cleaner that sucks capital into the US dollar. So, how do you track this without getting a PhD in economics? You use the economic calendar. This is a free tool available on sites like Forex Factory or investing.com. It lists every scheduled economic data release for every country. Most of it is noise. You can ignore the low impact, yellow, and medium impact, orange events. You are hunting for the high impact events, usually marked in red. There are 3 red folder events that you must respect as if they were live grenades. First is the NFP non-farm payrolls. This is released on the first Friday of every month at 8:30 a.m. New York time. It tells us how many jobs the US economy added or lost, excluding the farming industry. It is the most watched statistic in the world. Imagine you are in a trade. You have your stop loss set. It's 8:29 a.m. The market is quiet. Too quiet. At 8 hours and 30 minutes, the number is released. Let's say the US added 300,000 jobs instead of the expected 150,000. This is huge news. Algorithms instantly interpret this as a strong economy, meaning the Fed might keep interest rates high. In milliseconds, billions of dollars of sell orders hit the euro to US dollar. The price drops 50 pips in 1 second. Here is the danger. Liquidity disconnect. During that 1 second, there are no buyers. Everyone is selling. If your stop loss was at 1.0900, but the price jumps from 1.0905 to 1.0850 instantly, your broker cannot fill your order at 1.0900. There was nobody there to buy it from you. You get filled at the next available price, 1.0850. This is called slippage. You just lost 50 pips more than you planned. Your risk management math from step 4 is broken. You could lose 5% or 10% of your account in a blink. The second event is CPI, Consumer Price Index. This measures inflation. Inflation is the enemy of currency. If inflation is high, the central bank must raise interest rates to cool it down. Therefore, high inflation data often leads to a stronger currency in the short term, as the market anticipates future rate hikes. The third and most powerful is FOMC, Federal Open Market Committee, rate decisions. This is when the Fed chairman, currently Jerome Powell, announces the actual interest rate and speaks to the press. During the press conference, every single word he says is analyzed. If he says the word disinflation, the markets rally. If he says pain, the markets crash. The volatility during these speeches is erratic. Price can spike up 100 pips, trigger the stop losses of the sellers, and then immediately crash down 100 pips to trigger the stop losses of the buyers. This is called a stop hunt or a whipsaw. So, what is the strategy for step 5? How do you trade this? For a beginner, the strategy is simple: you do not. Your rule for the first 6 months is avoidance. You check the economic calendar every Sunday morning before the week starts. You write down every red folder event involving the US dollar, since it affects almost everything, and the specific currencies you are trading. If the NFP comes out at 8:30 a.m. on Friday, you have 2 choices. You ensure you are flat, no open positions, by 8:15 a.m. If you are already in a winning trade, you move your stop loss to break even or take partial profits to protect yourself. Do not try to gamble the news. Do not try to guess the number. There are hedge funds with satellite imagery of parking lots trying to predict retail sales, and even they get it wrong. You have no edge there. Your edge is in the aftermath. The professional trader waits for the news to be released. They wait 15 to 30 minutes for the amateur panic to settle. They let the dust settle to see the true direction. For example, if the NFP is positive and the dollar spikes up, but then 30 minutes later the price starts failing and moving back down, that is a genuine signal. That tells you the market does not believe the data, or that the move was just a liquidity grab. You can then use your technical analysis, step 3, to enter in the direction of the true flow, with a safe stop loss because liquidity has returned to the market. This concludes the 5 simple steps to start Forex trading. Let's recap your arsenal. Step 1. You have calibrated your psychology to think like a casino, not a gambler. Step 2. You have set up a safe, regulated infrastructure with the right broker and charting software. Step 3. You can read the technical map, candlesticks, structure, support/resistance. Step 4. You have a mathematical system, risk management, stop losses, position sizing. Step 5. You understand the fundamental engine, economic calendar, interest rates, and know when not to trade. You now possess the theory. You have the knowledge that separates the 10% of profitable traders from the 90% who fail. But knowledge is not skill. You can read a book on how to perform heart surgery, but that does not mean you should pick up a scalpel tomorrow. There is a massive gap between knowing what to do and actually doing it when real money is on the line and your heart is pounding through your chest. The next phase of this masterclass is about bridging that gap. It is about validation. How do you know your strategy actually works before you risk a single dollar? You don't guess. You prove it. You need to travel back in time. In part 7, we are going to introduce you to the concept of backtesting. I am going to show you how to simulate years of trading in a single weekend. We are going to build a track record from scratch. This is the boring, repetitive work that the get-rich-quick gurus never show you. But it is the exact work that builds the conviction you need to hold a trade when every instinct in your body is screaming at you to fold. We are going to turn your trading plan into a proven business model. Part 7 is where the simulation begins. Part 7 is the separation phase. This is the filter. This is the stage where 99% of the people watching this video will drop off, and it is exactly why 99% of traders fail. We are talking about backtesting. If you wanted to build a bridge, you would not just sketch a design on a napkin and immediately start pouring concrete over a river. You would build a model. You would run computer simulations. You would test the structural integrity against wind, earthquakes, and weight loads in a virtual environment before you risked a single human life. Yet, in trading, people take a strategy they found on a forum 5 minutes ago and immediately throw their life savings at it. They skip the simulation. They skip the stress test. Backtesting is your time machine. It is the process of manually scrolling back to a previous point in history, say January 1st, 2020, and replaying the market candle by candle as if it were happening live. You apply the rigid rules we defined in Step 4. You take every valid trade, you record every win and every loss, and you generate a dataset that proves whether your edge is real or imaginary. To do this, you need a specific tool. The industry standard is the bar replay feature on TradingView. Here is your exact workflow for the next weekend. You are going to clear your schedule. You are going to open the Euro to US dollar chart on the 4-hour time frame. You are going to click bar replay and cut the price action off going back 2 years. Your screen should show empty space on the right side. You have no idea what happens next. You press play or forward one candle at a time. You watch the price action unfold. You wait. You see a higher high. You see a higher low into a support zone. You see a bullish hammer. Your checklist from Step 4 screams by. You pause the simulation. You open a spreadsheet, Excel or Google Sheets. You log the trade. Date, February 12, 2020. Pair, Euro to US dollar. Entry, 1.1000. Stop loss, 1.0950. Take profit, 1.1150. Risk reward, 1:3. Then and only then you press play again. You watch the candles print. Does price hit your stop loss? Or does it hit your take profit? You do not cheat. You do not say, oh, I would have closed it early. No, you follow your rules. If it hits the stop, you mark -1R, -1 unit of risk, in your spreadsheet. If it hits the target, you mark +3R. You repeat this process until you have logged 100 trades. Not 10, not 20, 100. Why 100? Because of statistical variance. You can flip a coin 10 times and get heads 8 times. If you stop there, you might conclude that the coin lands on heads 80% of the time. But if you flip it 1,000 times, the data will smooth out to 50/50ths. In trading, you might have a winning strategy that just happens to have a losing streak of 5 trades in a row. If you only backtest 10 trades, you might throw away $1 million strategy because you happen to test it during a bad week. Once you have your 100 trades, you look at the bottom line. What is your strike rate? Win percentage? What is your average risk to reward? What is your maximum drawdown? Maximum drawdown is the most terrifying statistic you will uncover. It measures the deepest dip in your equity curve from a peak to a trough. It answers the question, what is the worst-case scenario? If your backtest shows that at one point you lost 8 trades in a row, resulting in an 8% drawdown on your account, that is gold. Why? Because when you go live and you inevitably lose 3 trades in a row, you will not panic. You will not change your strategy. You will look at your data and say, this is normal. My system survives 8 losses in a row. I am only at 3. I stick to the plan. This data builds conviction. Conviction is the only thing that keeps your hand steady when the market is screaming at you. Without backtesting, you are operating on faith. With backtesting, you are operating on facts. But backtesting has a flaw. It lacks the emotional component. When you lose a trade in a simulation, you do not feel pain. You just click next. You do not feel the urge to revenge trade. You do not feel the sweat on your palms. To bridge this gap, we move to forward testing, also known as paper trading. This involves using a demo account. Every major broker offers this. It is a mirror of the real market, with real-time data, real spreads, and real commissions, but the money is fake monopoly money. Your goal here is to treat the demo account exactly like a real bank account. If you plan to deposit $5,000 of real money eventually, do not open a demo account with $1 million. That is useless. It creates unrealistic expectations. Open the demo with $5,000. You are now testing your execution skills. Can you actually calculate the position size fast enough? Can you place the stop loss correctly before the market moves? Can you wake up at 7 a.m. every day to check the charts? You need to run this forward test for at least 1 month. If you cannot be profitable on a demo account for 1 month, there is absolutely zero chance you will be profitable with real money. None. The market does not become easier when you add the psychological pressure of losing your rent money. It becomes infinitely harder. Case study. The tale of 2 traders. Trader A, let's call him the architect, spends 2 months backtesting. He knows his strategy has a 45% win rate, but a 1-to-3 risk-to-reward ratio. He knows his worst losing streak was 7 trades. He spends another month on demo refining his routine. He makes mistakes, misses entries, and fixes them without losing a dime. Trader B, the gambler, watches a few videos, deposits $2,000, and starts trading immediately. He wins his first 2 trades. He feels like a genius. Then he loses 4 in a row. He panics. He thinks the strategy is broken. He goes to YouTube, finds a new strategy, and tries that. He loses again. He doubles his bet to make it back. He blows the account. The architect enters the live market with boring mechanical confidence. The gambler enters the market with hope and leaves with regret. Backtesting transforms you from a participant into an observer. It allows you to trust the math over your feelings. When you have a spreadsheet proving that your edge works over the last 2 years, you stop caring about what happens in the next 2 hours. You start thinking in probabilities. However, there is one final barrier. There is a psychological cliff that no amount of backtesting or demo trading can prepare you for. It is the chemical change that happens in your brain the moment real capital is at risk. You can walk on a wooden plank if it is lying on the ground. It is easy. You can do it perfectly every time. But take that same plank with the same width and the same stability and place it between 2 skyscrapers 100 stories up. Suddenly, your legs shake. You can't breathe. The task is the same, but the consequence of failure has changed. In Part 8, we are going to discuss going live. I am going to teach you how to cross that plank without falling. We will discuss the technique of microscaling, which allows you to trick your brain into staying calm. We are going to transition from the simulation to the real world. The safety net is about to be removed. Part 8 is next. Part 8 is the baptism by fire. We are now discussing the transition to live capital. This is where the rubber meets the road and unfortunately where the car usually crashes. You have completed your backtesting. You have traded on a demo account for a month. You have a plan. You feel confident. You deposit your funds into a live brokerage account. You see the setup. It is the exact same setup you have traded 50 times in the simulator. You click buy, and suddenly your hands start shaking. You are glued to the screen. Every tick down feels like a physical punch to the gut. Your heart rate spikes to 120 beats per minute. You are not looking at the chart anymore. You are looking at the profit/loss number flashing red. You think, I can't lose this money. I need this money. You panic. You close the trade for a small loss just to stop the pain. 5 minutes later, the price reverses and goes exactly where you thought it would. You stare at the screen in disbelief. What just happened? You experienced amygdala hijack. The amygdala is the ancient part of your brain responsible for the fight or flight response. It does not understand the difference between a lion chasing you on the savannah and a red candle on a screen. It only knows threat. When real money is on the line, the threat is real. The amygdala takes over and shuts down your prefrontal cortex, the logical, rational part of your brain that knows your trading plan. You literally become stupider the moment you enter a live trade. This phenomenon is why there are millions of demo millionaires who cannot make a dime in the live market. The strategy didn't change. The market didn't change. The biology changed. So how do we hack this? How do we bypass the amygdala? We use a technique called micro-scaling. Do not deposit $5,000 and start trading full lots immediately. That is ego. That is trying to prove you are a big shot. The market loves to crush big shots. Instead, you are going to deposit the minimum required to open the account, perhaps $500 or $1,000, but here is the key. You are going to trade the absolute minimum position size allowed by the broker. In the US, this is usually a micro lot or 0.01 lots. A micro lot means you are trading 10 cents per pip. If the market moves 50 pips against you, a significant move, you lose $5. Why do we do this? Because $5 does not trigger the amygdala. You can lose $5 and not feel your heart rate spike. You can lose $5 and still sleep at night. Your goal for the first 90 days of live trading is not to make money. Read that again. If you try to pay your bills with trading in your first 3 months, you will go broke. Your goal is desensitization. You are training your brain to execute the plan flawlessly without emotional interference. You need to prove to yourself that you can take a loss, see the red number, and do absolutely nothing. You just accept it. You need to verify that you can let a winner run to your take profit target without closing it early out of anxiety. Think of it like lifting weights. You don't walk into the gym on day one and try to bench press 300 pounds. You will tear a muscle and drop the bar on your neck. You start with the empty bar. You perfect the form. You build the muscle memory. Only when the form is perfect do you add 5 pounds. This is the earn the right protocol. Imagine this scenario. You start with 0.01 lots. You trade for 2 weeks. You take 10 trades. You followed your plan on every single one. You didn't move your stop loss. You didn't revenge trade. You are profitable. Now and only now you have earned the right to increase your size to 0.02 lots. You trade another 10 trades. You follow the rules. You increase to 0.03. But, and here is the catch, if you break a rule even once, if you move a stop loss or take a gamble, you get demoted. You go straight back down to 0.01 lots. You have to earn your way back up. This turns trading into a performance game, not a money game. You are gamifying discipline. During this phase, you must introduce the post-mortem audit. Most traders look at their account history to see how much money they made. That is a vanity metric. A professional looks at their journal to see how they made the money. You need to keep a strict journal. For every trade you record. The technical setup, why did I enter? The outcome, win/loss. The emotional state, how did I feel? If you see a note that says, I felt scared so I closed the trade early, that is a failure. Even if you made money on that trade, it is a failure because you let emotions dictate the action. You reinforced a bad habit. Conversely, if you took a valid setup, held it to the stop loss and lost money, that is a good loss. You followed the plan. The market just didn't pay out this time. You reward yourself for that execution. Let's look at a comparative case study to hammer this home. Trader A, the sprinter, funds his account with $5,000. He risks 2% per trade, $100. He loses his first trade. He is down $100. He feels the sting. He wants it back. He takes a subpar trade to recover. He loses again. Now down $200. He is angry. He increases his risk to 4% to get back to break-even in one shot. He loses. He is down $400 in 2 days. His confidence is shattered. He withdraws the remaining money and quits, telling everyone Forex is a scam. Trader B, the marathon runner, funds her account with the same $5,000. But she risks 0.1% per trade, $5. She loses her first trade. She is down $5. She shrugs. It's the price of a coffee. She analyzes why it failed, just normal market variance. She takes the next setup calmly. She wins $15. She is up $10 net. She feels no euphoria, just satisfaction that the system worked. Over 3 months she slowly scales up. She is not rich yet, but she is still in the game. She is building a career. The market is a graveyard of sprinters. It is owned by the marathon runners. You have to accept that the first live loss is a rite of passage. It will happen. When it does, your brain will scream at you to fix it. You must override that scream. The best thing you can do after your first live loss is to stand up, walk away from the computer, and close the office door. Do not trade again that day. Break the cycle before it starts. You are building emotional resilience. This is a muscle that can only be built through exposure to stress, followed by recovery. Stress plus rest equals growth. If you just stress yourself continuously without stepping away, you will burn out. So, we have successfully transitioned to live trading. You are starting small. You are journaling. You are managing your psychology. But as you scale up, as you start trading with $1,000 risk or $10,000 risk, a new enemy emerges. It is not the fear of losing. It is the arrogance of winning. There is a distinct phase in every trader's journey called the God complex. It happens usually after a winning streak. You feel invincible. You feel like you have solved the market. You start to believe you can predict the future. And that is exactly when the market is preparing the biggest humble pie you will ever eat. There is a statistical probability known as the drawdown of ruin. It is a mathematical certainty that eventually, your strategy will stop working for a period of time. Market conditions will shift. Volatility will dry up. In Part 9, we are going to discuss longevity and scaling. I am going to show you how to survive the inevitable winter of your trading career. We will talk about when to pull profits out, how to compound your account safely, and how to ensure that one bad month doesn't wipe out one good year. We are moving from how to start to how to stay. Part 9 is next. Part 9 is about survival. It is about the paradox that success kills more traders than failure. This sounds counterintuitive, but historical data from brokerage firms confirms a startling trend. The largest account blowups often occur immediately following a trader's most profitable month. We call this phase the God complex. Imagine you have just finished the best month of your life. You followed your plan. You caught 3 massive trends. Your account is up 20%. The dopamine in your brain is firing at levels usually reserved for lottery winners. You look at the chart and you no longer see probabilities, you see certainty. You start to believe you have cracked the code. You think, if I made 20% risking 1%, imagine if I risked 5%? I could retire by Christmas. This arrogance is the siren song of the market. The moment you begin to think you are bigger than the market will destroy you. It waits for you to leverage up, and then it shifts its character completely. This brings us to the concept of market seasons. Just as a farmer knows he cannot plant crops in the snow, a trader must know that strategies do not work in every environment. Markets cycle between 2 primary states: trending, directional, and consolidating, ranging. If your strategy is built on trend following, buying breakers and riding the wave, you will look like a genius during a trending market. But the moment the market enters a consolidation phase, chopping sideways in a tight range, your strategy will fail. You will buy the breakout and it will reverse. You will sell the breakdown and it will reverse. You will get stopped out 5, 6, 7 times in a row. This is the winter. Most amateurs try to fight winter. They think, my strategy is broken. I need to fix it. They start tweaking indicators, changing stop losses, and forcing trades. This is how they lose the entire profit they made during the summer. The professional accepts winter. When they recognize the market condition has changed, they do not fight. They retreat. They go into preservation mode. We implement a strict risk management protocol here called the rule of halves. The rule of halves is your emergency brake. It works like this. Let's say your standard risk is 1% per trade. You hit a losing streak. You are down 5% for the month. This is your warning light. Instead of trying to make it back quickly, you immediately cut your risk in half. You are now trading 0.5% risk. If you continue to lose and draw down another 2.5%, you cut it in half again to 0.25%. Why do we do this? Because when you are losing, two things are happening. Your psychological state is compromised, you are frustrated and prone to errors. The market condition is likely mismatched with your strategy. By reducing your risk, you survive the storm. You can lose 20 trades in a row at 0.25% risk and still have your account largely intact. You stay in the game long enough for the market conditions to shift back in your favor. When you start winning again, you scale your risk back up slowly. This defense is critical because of the mathematics of recovery. If you lose 10% of your account, you need an 11% gain to get back to break-even. That is manageable. If you lose 50% of your account, you need a 100% gain just to get back to zero. If you lose 90% of your account, you need a 900% gain. That is mathematically impossible for a consistent trader. The hole gets deeper faster than you can climb out. Your primary job is not to make money. It is to prevent the hole from getting too deep. Now let's discuss scaling. How do you actually grow a small account into a large one? The internet will tell you to use compound interest. They show you spreadsheets where $1,000 becomes $1 million in 3 years just by compounding 5% a month. In theory, the math works. In reality, the psychology breaks. Trading with a $1,000 account feels different than trading with a $100,000 account. When you risk 1% of $1,000, you are risking $10. It is a lunch. When you risk 1% of $100,000, you are risking $1,000. It is a mortgage payment. If you simply keep compounding, eventually the dollar figures will become so large that they trigger your amygdala again. You will start hesitating. You will close trades early. You will sabotage yourself because your financial thermostat is not set to handle those swings. To solve this, we use plateau scaling. Imagine you start with $5,000. Your goal is to get to $10,000. You compound your profits until you hit $7,500. Then you stop compounding. You keep your risk size the same, based on $7,500. Even as the account grows to $10,000, you let your mind acclimatize to the new numbers. You normalize the stress. Only when you are completely bored with the new numbers do you unlock the next level of growth. But there is a catch. If you keep all your money in the account to compound it, it never becomes real. It is just pixels on a screen. If you lose it, your brain treats it like losing points in a video game. To become a professional, you must pay the trader. You need a systematic withdrawal strategy. I recommend a 50-50 split once you are profitable. At the end of every profitable month, you take 50% of the profit out of the account. You send it to your bank. You buy a nice dinner. You pay a bill. You put it in a savings account. The other 50% stays in the account to build your capital base. When you spend the money you made from trading on something tangible, like a new pair of shoes or a weekend trip, it wires a connection in your brain. It makes the reward real. It reinforces the discipline. Your brain understands. If I follow the rules, I get to eat steak. This positive reinforcement is infinitely more powerful than looking at a high number on a screen. This also protects you. If you have a catastrophic blow-up, which we try to avoid, but anything is possible, you have already secured the profits. The market cannot take back what is already in your pocket. Longevity is about being the last man standing. In a room of 100 traders, 90 will blow up in year 1. Of the remaining 10, 5 will blow up in year 2 because they got cocky. You want to be one of the final 5 who are boring, consistent, and defensive. Case study: the turtle versus the hare. We have seen traders turn $1,000 into $50,000 in 2 months by aggressively over-leveraging. They are hailed as heroes on social media. 6 months later, they are gone. Their account is zero. They are back to working 9 to 5. Then we see the trader who makes 3% a month. It is boring. Nobody claps for 3%. But over 5 years with compounding and scaling, that trader manages a 7-figure portfolio and lives a life of total freedom. The hare runs fast and dies young. The turtle owns the finish line. So you have the roadmap. You know how to start. You know how to survive. You know how to scale. But there is one final obstacle. It is the capital ceiling. Even with perfect trading, it takes years to turn $1,000 into a full-time income. Most people do not have the patience for that. They need significant capital now to make significant returns. This used to be impossible for the average person. You had to be born rich or raise money from investors. But in the last few years, The entire landscape of Forex trading has been revolutionized by something called proprietary trading firms. This is the cheat code. This is how you skip the 10-year grind of building a small account and jump straight to managing $100,000 or even $500,000 of someone else's money. In the final part of this masterclass, part 10, I am going to reveal how the prop firm model works. I will explain how you can take a test, prove your skills, and get funded with massive capital, keeping up to 90% of the profits. This is the end game. This is where you turn a skill into an empire. Part 10, the end game. We have arrived at the final frontier of retail trading. If you have followed this masterclass from the very beginning, you now possess the mindset, the technical skills, the risk management protocols, and the fundamental awareness to navigate the markets. But you likely still face the one hurdle that stops skilled traders from becoming wealthy traders: capital. Let's face the brutal math. If you are a consistent trader making a respectable 4% return per month, which is an excellent professional rate of return, and you are trading a $2,000 account, you are making $80 a month. That is barely enough to pay your internet bill. To replace a $50,000 annual salary, you would need a capital base of over $100,000. For most people, saving $100,000 to risk in the markets is a decade-long struggle. This is where the proprietary trading firm, or prop firm, revolutionizes the industry. This is the cheat code I teased in the last video. A prop firm is a company that effectively says, "We have the capital, you have the skill. If you can prove you can trade without losing our money, we will give you a funded account of $100,000, $200,000, or even $500,000. You trade it. You keep 80% or 90% of the profits. We take the rest." Imagine if a Formula One team told you, "We will give you the car, the fuel, and the crew. You just drive. If you win the race, you keep the prize money. You don't need to buy the car. You just need the skill to drive it." But they do not just hand you the keys. You have to pass the evaluation. This is the barrier to entry. It is designed to filter out the gamblers from the professionals. Typically, the process works like this. You pay a one-time fee, say $500, to take a challenge for a $100,000 account. Phase 1. You must make a specific profit target, usually 8% or 10%, within a certain time or with no time limit, while ensuring you never lose more than 5% of the account in a single day or 10% total. If you pass Phase 1, you move to Phase 2. Phase 2. This is the verification stage. The target is usually lower, perhaps 5%, to prove your first result wasn't luck. The risk rules remain the same. If you pass both phases, you become a funded trader. The firm gives you login credentials to a live account. The $500 fee is often refunded to you with your first payout. From that point on, you are trading with the house's money. Let's look at the return on investment, ROI potential here. Scenario A. You trade your own $500. You make 10% in a month. That is $50 profit. Scenario B. You use that $500 to buy a challenge. You pass. You are now trading a $100,000 account. You make the same 10% return. That is $10,000 profit. The firm takes $2,000, 20%. You keep $8,000. Same skill, same charts, same trades. One path pays for a dinner, the other pays for a car. This is leverage of capital, and it is vastly superior to leverage of margin. However, I must issue a severe warning. Prop firms are not charities. They are businesses. They know that statistically 90% of traders fail the evaluation. They pocket the evaluation fees of the failures to pay the withdrawals of the winners. If you attempt a prop firm challenge before you have mastered steps 1 through 9 of this series, you are simply donating money to them. The rules of these firms are strict. The daily drawdown rule is the widowmaker. If you have a $100,000 account and the rule is max 5% daily loss, that means you cannot lose more than $5,000 in a single day. If your equity drops by $5,001, the account is breached. The contract is terminated. You lose everything. This brings us full circle to step 4, your mathematical system. If your risk management is loose, if you risk 2% per trade and lose 3 trades in a day, you are down 6%. You just blew the prop firm account. This is why we preached risking 0.5% or 1%. With 0.5% risk, you would need to lose 10 trades in a single day to breach the limit. That is highly unlikely for a disciplined trader. The prop firm environment forces you to be professional. It punishes the gambler instantly. So, how do you integrate this into your career? You do not start here. You start with your personal account. You build your track record. You build your confidence using microscaling. Once you have 3 to 6 months of consistent profitability on your own funds, then you take a portion of your profits and buy a challenge. Treat the challenge fee as a business expense. If you fail, you do not quit. You analyze the failure, go back to the simulator, refine the edge, and try again. There are traders today who manage millions of dollars across multiple prop firms. They have diversified their liquidity. They have a $200,000 account with firm A, a $300,000 account with firm B, and a $100,000 account with firm C. If firm A has a technical issue or shuts down, they are safe. They are acting like a hedge fund manager, not a retail day trader. This is the summit. We have climbed the mountain. Let us look back at the path we have carved. We started with the mindset. We accepted that trading is a game of probabilities, not certainties. We learned to think like the casino, not the player. We built the infrastructure. We navigated the US regulatory maze, chose the right broker, and set up our charting station. We mastered the map. We learned to read the language of candlesticks, market structure, and support and resistance. We constructed the system. We defined our edge, our risk-to-reward ratios, and our position sizing algorithms. We studied the engine. We learned to respect the economic calendar and the flow of global interest rates. We validated through backtesting. We proved our edge in the simulator before risking a dime. We survived the transition. We used microscaling to override our biology and conquer the fear of loss. We planned for longevity. We learned to scale safely and defend against the seasons of the market. And finally, we unlocked unlimited scale through the prop firm model. This is not a get-rich-quick scheme. If you watch this entire series looking for a magic indicator that never loses, you are disappointed. Good. That disappointment saves you money. The secret is that there is no secret. The secret is the work. The secret is waking up at 5 a.m. to mark your charts when everyone else is sleeping. The secret is journaling your losses when it hurts to look at them. The secret is sitting on your hands and doing absolutely nothing for 3 days straight because your setup isn't there. Trading is the hardest way to make easy money. It will challenge your ego, your patience, and your sanity. It will force you to confront your deepest character flaws. You cannot hide from the market. The chart is a mirror. If you are undisciplined, the market will show you. If you are greedy, the market will show you. If you are fearful, the market will show you. But if you can conquer yourself, if you can master the discipline to execute a simple set of rules consistently over a long period, the market will give you a life that 99% of people can only dream of. Gives you total freedom. No boss, no clients, no inventory, no commute, just you, the chart, and your skill. You now have the blueprint. The information is no longer the bottleneck. The only variable left is you. Do not let this be just another video series you watched and forgot. Take action. Open the demo account. Start the backtest. Write the plan. The market opens again on Monday. It is waiting for you. This has been the How to Start Forex Trading Deep Dive Masterclass. If this series has provided you with value, if it has clarified the fog of the financial markets, then your next step is crucial. We are building a community of serious, data-driven traders. We are going deeper into specific strategies in the coming weeks. Subscribe to the channel, turn on notifications, and in the comments below, I want you to write one sentence. I am the casino. Declare your intention. Set your psychological anchor. I will see you on the charts.